Welcome out to episode 206 of the Trading Justice podcast. This is Coach T, Tim Justice, one of your hosts, and we've got a very exciting episode for you. We're going to go through the market itself, kind of talk about what's going on in the news like we always do. We're going to highlight some of our favorite movies. It was Academy Awards season just this last weekend, and Jimmy Kimmel hosting that, quite a blunder at the end, I should say. Matt and I will discuss that, and we'll talk about our own favorite movies and worst movies and all that kind of thing. Then we're going to get into some trading ideas, and one of the strategies we're going to highlight today is one of my favorite strategies, which is a high probability system and strategy called an Iron Condor. And we'll give you some of my favorite tips and tricks in understanding an advanced strategy in the options market and how to apply that into your own business and when it's appropriate. Then we'll go through, some stuff at the end where we go through our clown of the week and all that kind of stuff. Episode 206 is brought to you by Tackle Trading. And I got to tell you, friends, if you want to join a trading community, there's not a better one online than Tackle Trading. Being a trader now for 12 years, one of the best things I ever did was start this with my brother, Matt, and do it together. And having, friends and colleagues and people to lift you up and help you when you need it. That's invaluable in any business that you're going to start. And in the online trading world, it can be hard to find those people, but that's where Tackle Trading comes in. Go over to tackletrading.com. If you want to try out the pro membership, just put in the code JUSTICE15, the number 15, so the word justice, the number 15, and we've arranged it to where you can get 15 days of the pro membership for free. This is episode number 206 of the Trading Justice podcast.
The TJ Newsstand, where stars are born and often shine, and necessary shade is thrown from time to time, and that's just fine. The TJ Newsstand is brought to you by Tackle Trading. If you're sick of the bench, get in the game, and get in the game with Tackle Trading.
Matt, and interesting stuff that's going on in the market right now. But before we get into the market, Matt, I want to talk movies because I know the Academy Awards were last weekend. You're a big movie guy. I know that pretty much with your travel schedule, you get a chance to watch some of those, and I know you well enough to where you usually keep up to date on the movies. What did you think of the Academy Awards last week?
Well, I didn't actually watch the award show. I had other things I was doing, but I was I don't know, it was about 10 o'clock at night my time, and I was just checking Twitter and checking my Twitter feed, and I saw like people were losing their mind on on social media about what happened at the end, and apparently we had a little bit of a gaffe. As Faye Dunaway and what's his name? Can't remember his name. It was
Warren
just on
Beatty,
top.
right?
Warren Beatty, yeah, Warren Beatty.
Yeah.
So Faye Dunaway and Warren Beatty were getting up and they were presenting the Best Picture, which is obviously the number one thing that the Academy announces. And all of a sudden, the Warren Beatty opens up the card. And again, I didn't see this live. I just saw it as I was basically, hitting a video on Twitter. And Warren Beatty opens up the card and he's just staring at the card. And Faye Dunaway kind of hands it to Faye Dunaway, and Warren Beatty was the one that was supposed to announce the Best Picture. And Faye Dunaway stares at the card and finally says, "La La Land," right? And La La Land I have not seen, but La La Land was the favorite to win the Best Picture. And so they get up to him and they rush the stage, they're hugging, they're crying, they're high fiving, they're giving speeches, and like three speeches in to the Best Picture nomination, right? All of a sudden, just this scuttlebutt starts happening, and people start talking. And one of the people from the Academy come out and they whisper something in somebody's ear, and then Jimmy Kimmel, who's hosting the awards, gets up, and like there's this mass confusion, and nobody knows what's happening. All of a sudden, the producer of La La Land gets up and holds up a new card and says, "Moonlight won the Best Picture. I'm not kidding. Moonlight, you are the Best Picture of 2016." La La Land, after giving the speeches, had to basically announce that they were given the wrong card. Warren Beatty and Faye Dunaway were given the wrong card by Price Waterhouse, and
So
so basically it was just massive confusion, and I could not imagine the basically the embarrassment to a certain extent.
So I got a question for you. So worst
Yeah.
execution, this Warren Beatty delivery of the Academy Award, or ex-President George Bush's coin flip at the Super Bowl? Did you see that?
Oh, but I did, and it was not a good. But and I'll bet you if it was anybody else, they
They
probably
would
would have
have reflipped.
reflipped
He
that.
just
They would have reflipped that. But nobody's going to tell George H.W. Bush, who is widely loved by everybody.
Oh yeah.
Nobody's going to tell him, hey, listen, you got to flip that again. Plus, he's like a 90-year-old man, and he's doing his best, and that. So I'm not going to blame it. I'm going to blame the Academy and Price Waterhouse. I don't blame Warren Beatty. Warren Beatty, like, I mean, he gets this card and he's just staring at it, and he's like, I don't know what to do. Like they literally make two copies of every announcement, and they were just given the wrong card. And so it's embarrassing, and it's kind of sad. But movies are an important part of our culture, and I grew up watching movies. And I used to watch the Academy Awards and the Oscars and whatnot. I don't anymore. I don't get into the award season like some other people do, but I do love movies. But the problem, Tim, is when I remember in my childhood back in the 90s, 80s, 90s, and 2000s, I remember watching some of those movies that actually won, like Braveheart and Saving Private Ryan and
Yep.
Gladiator, and I still remember Moulin Rouge when it didn't win. I was like, wow, that should have won. I love that movie. But I look at this list, and I'm sure these movies are awesome movies, and there's some I want to see, but I haven't seen any of these movies, Tim. Like I just I haven't. I haven't when I was thinking about, okay, what was the best movie from last year, and I'm looking at the best picture, and I'm like, okay, I haven't seen Arrival, I haven't seen Fences, haven't seen Hacksaw, haven't seen Hell or High Water, haven't seen Hidden Figures, La La Land, Lion, Manchester, or Moonlight. I haven't seen any of them, and they're probably good movies. And Tim, I'm thinking of, okay, what movies did I watch last year that were awesome, I thought? And I'm thinking, man, I loved Rogue One, I loved Cap America, I loved Moana, I loved Deadpool, I loved Zootopia, and I'm thinking, wow, I'm an old guy with kids.
It's
I mean,
true. Well, think about it. I mean, I'll just, it's a function of you and me changing what we do with our lives. 2016 didn't see the best picture. 2015 didn't see the best picture. 2014 saw it a year after it came out, Birdman. 2013, 12 Years a Slave, didn't see it in movie theater. The last time like I've seen these movies, Argo,
okay.
20.
What was the 2015?
So I'll read these back to you. You tell me if you saw them in theaters.
Okay.
2016,
Okay.
Moonlight.
No.
Okay, 2015 Spotlight,
No.
2014 Birdman,
No.
2013 12 Years a Slave,
No.
2012 Argo, not in
No. Not
theater.
in the
You
movie
saw it
theater.
later, right? 2011 The Artist,
Argo's a great movie. No.
2010 The King's Speech,
No.
2009 The Hurt Locker,
No.
2008, this is the last one I saw in theaters, Slumdog Millionaire. I went and
No.
saw it in the theater. 2007 No Country for Old Men,
No.
2006 The Departed.
Yes.
So you haven't seen a movie, the best picture in theaters
10
for
years.
over a decade,
Now I've seen most of those movies in
right?
time,
Eventually,
right?
right?
Yeah, like on Amazon or Netflix or buying it on iTunes or something along those lines. But no, I haven't seen any of those movies. And again, a lot of them
But
great
if I read
movies,
the
just like this
1990s
list.
ones, I guarantee you would have seen them. I mean, I'll just do them quick. Dances with Wolves, Silences of
Yeah.
the Lambs,
Yes.
Unforgiven,
Yes.
Schindler's List,
Yes.
Forrest Gump,
Yes.
Braveheart, The
Yes.
English Patient,
Yes.
Titanic,
No.
Shakespeare in
Yes.
Love,
Unfortunately.
American Beauty,
No.
Gladiator.
Yes. Yes.
See?
8 out of 10. Yeah. Well, again, I mean, that's that's my teenage years and going into college, and but it's just different time now. When you have kids, you're going to Rogue One and Cap America and Moana and Zootopia and Suicide Squad and those types of things, right? You grow up and things get different. Now, will I watch Moonlight? Yeah, I will. Will I watch Manchester? Yes. La La Land, Hacksaw Ridge, Fences around. Yeah, I will watch these in time. Again, they're probably good movies. It's just you grow up, right? And you get kids, and you just can't go to the movie. I mean, when you have four kids and you have three, you just can't go to the movie with your wife like on any random day. It's just that's not how it works out because you have to take your child to dancing or to baseball practice or whatever the case is. It's a different time. But I will say that the best movie I watched last year that I enjoyed the most. I'm not saying it's the best picture, but the one I enjoyed the most was Rogue One. My whole family, we went to it, loved it. It's instant classic in my
Sure.
opinion. First hour a little slow, second hour awesome, just awesome. The worst movie I saw last year, and it's not even close to him, Independence Day.
Mhm.
And I'm gonna tell you, I was very sad at that because the original Independence Day back in 1996 was flat out awesome, right?
Right.
Just flat out awesome. And this one was just like I couldn't even finish it. It was that bad. Could not even finish it. But it's movies again. I love movies, but we just consume entertainment so differently today, and I think that's probably the biggest difference. Is not even just kids, but back 15, 20 years ago, we didn't have Netflix and Amazon and
Sure.
iTunes, and we could not consume things the same way. And that reminds me of just of trading and how trading has evolved over the last 10, 15 years, Tim. I mean, some guy just the other day made a like $100 million trade or put on $100 million trade from a cell phone,
Yeah.
Tim, from a cell phone and that's just unheard of 15, 20 years. Everything has just evolved in the technological era, and it's been quite fascinating. I do want to say one thing before we get into the trading edition of the podcast here. And I want to tell you a little story very quickly that I want to share with the listeners. As many of our listeners go, we have children, or we're going to have children at one point, and as your children get a little older, Tim, you have the birds and the bees talk, correct?
Well, I've never done that. As my daughter,
Well, you haven't yet.
well, no, my
You haven't
daughter's
yet.
16, and I remember I just said, "See your stepmom or your mom." I'm like, I had no interest. I have girls though, so I don't know. Maybe
That's
it's a
tougher.
little different relationship there, obviously. So I did not, but I can only imagine.
It is tougher. It like because I have a 19-year-old girl as well, and it's it's tougher to have that conversation. It's like, "Okay, you need to go talk to your mom about this stuff, right?" But with my son, he's 15, and he comes to me the other day and he says, Dad, I got the feels. And I said, son, what are the feels? What does the feels mean? I don't know what that means. And he's like, the feelings. I'm like, oh, you like a girl? And he's like, yeah, I do. I said, well, what's her name? And he tells me her name. I'm like, oh, that's awesome. And you and I go to the gym to play racquetball, and I'm telling you about Tanya having the feelings, and Tanya and Cam. Tim's first words to me were, Matt, you need to have the talk.
No, my
And I
first
said,
words were, "All right, Grandpa."
oh yeah, that's right. Yeah, she said, all right, Grandpa. And I said, oh, okay. Well, wait a second. I'm not going to be a 40-year-old grandpa. That's not happening, right? So I went home, Tim, and I took your advice, and I took Tam for a ride, and we went to get a drink at Holiday, and then we, went somewhere else. I can't remember. We were just driving around in the truck, and I said, "Hey, Tan, it's time for you and me to have the talk, right?" And he's like, Dad, no. And I'm like, no, Tan, we're having the talk. And he's just kind of sitting there begrudgingly and just not even paying attention. And I start talking about, the birds and the bees and sex and whatnot and how it's important to wait and to play this smart and, just motivating him to not, have sex is what I was trying to do. And he's not anywhere near that. He just has his feelings, right? But I wanted to have the talk, and talk's going on for about 15 minutes, right? And we're just driving around, and I'm not getting through to him in any capacity. I'm just not. He's not paying attention. He's just literally just not even listening to me. I said, okay, Tan, listen. You've seen How I Met Your Mother, right? He's like, oh yeah, funny show. And I'm like, okay, all right. So we're going to create a scale here, okay? And on the scale, you have Barney on the left-hand side of the equation, right? And Barney's frivolous, and he's a womanizer, and we all know, anybody who's watched How I Met Your Mother know who Barney is. And then on the right-hand side, you have Marshall. And on the far right, you have this Marshall character who has only been with one woman. He's only had sex with one woman. And then you have Ted in the middle. And it said, Tanyan, let's put it like this. You definitely do not want to be Barney. You do not strive to be
Barney.
Now you prefer, you want to be, you don't have to be Marshall. I'm not saying you have to be Marshall. Do you prefer to be Marshall? Maybe, but you don't have to be Marshall. And then you have Ted, who's constantly seeking love. Okay, so on this scale of the Barney Marshall scale with Ted in the middle, you want to be on the right side of Ted. You want to be somewhere in that zone between Marshall and Ted. Now again, can you be Marshall? Absolutely. Probably prefer. You even can be Ted. You just can't be Barney, Tan. And Tan looks at me and he says, Dad, I don't like you.
So he did understand the message, though.
But he did get it. He did get it.
So the message did come across, and
took me 30 minutes.
So couldn't you have said something like, Tanyan, this is a condom, and this is, a banana, and I'm going to show you how it works if and when you do want to have the sex. So you couldn't go the full Monty here. You didn't feel comfortable with that, so you went with the
analogy. Wasn't ready for that. I wasn't. Maybe in time, if we have a close relationship.
I don't worry about that kid. He's a good kid, but
he's a good
it is important though to talk to your kids about risk. There's no question about it. Oh my.
Okay, risk and return. You can take it into a trading analogy. Sure. If the return is $10, but the risk is an eternal lifetime of debt and being a parent at 16, and no, the risk is not worth the return. It's just not. Not when there's other ways. So, in terms of this, it's going to be an interesting thing. But yeah, it's not the only talk we're ever going to have. But I thought it was, after I got back, I just thought, oh my God, I cannot believe I used a How I Met Your Mother analogy in the Birds and the Bees talks, but it worked. It worked, and I thought it was
as long
excellent.
as you executed, Dad. I mean, honestly, that's your job.
It was executed appropriately.
All right.
It was executed appropriately. You've been listening to the Trading Justice podcast presented by Tackle Trading. Get in the game with Tackle using the coupon Justice15 in a pro member coupon, and you can see everything we do over there at Tackle. We'll be right back.
You're in the middle of a battle, the heat of the game. You can't always see exactly what's going on in the playing field. Welcome to the press box, or as we like to call it, the market skyline. Get a bird's eye view of the market's indices, forex, and commodities here in the market skyline.
Welcome back. Let's dive right into the marketplace. There's a lot going on with stocks and, commodities, gold and silver and whatnot. We're going to go through them detail by detail. Matt, whenever we do the market skyline, we always start with equity prices. And there's a lot of different ways to look at equities. You could look at the overall Dow Jones or the NASDAQ. But it seems to be we always look at the S&P 500 first, good balanced marketplace.
Yeah.
We're at an all-time high. We're slowing down, and we're heading into kind of a low volatility season in the month of March. What's your read on the market right now?
Well, I think we should call the National Guard. We're down 6 points today in the market. I think we need the plunge protection team to come in and really kind of stabilize the market being down less than 0.5%. I think it's down 0.3% right now. But that's a big down day in the market right now. I mean, it's just like we talked about last week and talked about the week before. It's bullish until it's not. Whether you agree with the economics behind it or the policies behind it or the manipulation behind it, it's bullish until it's not. It's at a high point. We are slowing momentum. I do expect either some simple consolidation this week or maybe even a downward movement in price. But when I'm looking at the S&P 500, we're bullish positive too. We're buying stock, we're buying calls, we're just buying things. If it's overextended, wait for it to retrace. But I'm looking at a high base right now in an uptrend, and that's typically indicative of a breakout somewhere in the future.
Yeah, absolutely, no question about it. And it is bullish until it's not. It doesn't really matter what your politics are, your opinions. You have to trade whatever the tape is saying. We've always said trade what you see. That's a phrase that you're going to hear from us quite often as mentors and teachers, Matt. And right now, market is showing strength. I will say this, though, there is risk potentially with some of the political stuff. I know that President Trump, will be up in front of Congress here over the next few days talking about his budget and his potential for infrastructure spending. We talked about this many times on the podcast, Matt, that, getting to actually deliver what you want to do politically is a very difficult thing. Do you think that these, promises, are they going to come through? If not, how will that affect the potential market?
They're going to come through in some capacity. That Trump, Republicans control president and the Congress, so they're going to come through. Infrastructure spending, which again is something I support, that's going to come through. Aerospace and defense spending, you're looking at a 10% increase in the budget, which is about an extra $60 billion. Will that be $60 billion? Will they get $1 trillion for infrastructure? Will they get $60 billion for aerospace and defense? I don't know. They're going to come through in some capacity, but there's obviously going to be fight back. Just because you have a budget plan doesn't mean it's going to automatically get just rubber stamped, right? It still has to go through Congress, and a lot of Congress, may disagree with some of them. I would expect an increase in defense spending, and I would expect an increase in infrastructure spending to the level that they're hoping. I don't know, probably not. Maybe you get 30 billion in extra defense spending, and maybe you get 500 billion in infrastructure spending, but you are going to get some of it. I just don't think it's going to be what the actual plan calls for.
No question about it. But it's really interesting to hear him pushing his agenda. I've been very impressed with that part of this new president's administration. I can't remember a president that's come in so guns blazing, Matt. Honestly, I mean, just pushing. And who knows if those promises can come through. Defense spending should be up, is what they're saying. Infrastructure spending. And it will be interesting to see how he deals with Congress. I mean, they've got control of most of it right now, but it's going to be one to watch for sure. Another one to watch, Matt, in the market is always the Federal Reserve. And I just want to read across some of the data. Number one, GDP has been stronger than expected or in line with expectations. Home price index from the Schiller case, report that came out last week was strong. Chicago PMI, consumer confidence, they're all coming out. The reality is, as I look at data, there are some misses in the last month or so. Now, the Fed has to raise, don't they? I mean, based on what the numbers are coming in as, if we believe them, and you have to on their face, the economy is strong enough to where they have to follow through on this expectation of raising rates. What's your take on the Fed?
I look at that too, and I agree. The data does support raising interest rates. There's no doubt about that. And you can kind of see that already starting to happen in the bond market. The Fed talked about raising rates at their last meeting, and they're looking at potentially raising sooner than later. But I've also heard that for years and years now, T. I've heard the Fed. I remember the Fed in 2010, 2011, 2012, 2013 talking about potentially raising rates. I remember in 2013 specifically, as the markets were going up 33% in that year, the Fed was talking about raising rates, but they kept saying at the time, well, we're going to wait to unemployment. We're really looking at unemployment for 3 straight years, Tim. The Fed just said unemployment. It's got to get to 6%. It's got to get to 6%. And then when it got to 6%, the Fed said, no, unemployment's got to get to 5%. Once it got to 5%, they shifted to, okay, now that unemployment is kind of stabilizing, which again, the numbers are good, but if you look at behind the numbers, not so good. But let's just focus on the numbers. Let's not get into how they manipulate the numbers. So then they shifted to inflation, and they said for the last 2.5 years, 3 years, they've said, well, inflation's got to get 2%. Inflation's got to get 2% and whatnot. GDP's got to be above 2%. Inflation's got to be 2%. And, it was interesting that in their just recent meeting they talked about how they might have overshot on inflation and how inflation might go up a little quicker than what they expected. And my thought to that was very quite simple. Well, when you increase the supply of money by $10 trillion in 10 years, yeah, inflation is going to jump up a little higher than you expected. So I'm looking at the numbers here, Tim, and I see most of the economy doing fairly well, is what I see. I still see stagnation, but we're starting to see stabilization in that. And in that environment, if you just base off what the Fed tells us, what their barometer is, they got to raise rates. And
Well, the market thinks so
the
too.
question for the market,
I mean, I'll give you some
and the
numbers
market
here.
does
I'll
think
give
so
you
as
some
well.
numbers here. 30% market expectation for a hike in March. Okay, so that's coming up soon. Not a high number. 53% say that we will do it by May at least, and 70% thinks that by our June event, that with the Fed meeting, that we will have another quarter point bump. I'm in that
Yeah,
70% camp. I don't know if it will happen this time, Matt, but I believe that they will be going up again within the next quarter.
I think you're going to see 2 rate hikes the rest of the year, whether that comes through March, May, June, August, October, December. I don't know when it is. I mean, we can sit there and debate 30, 52, and 70%, but I do think you'll see 2 rate hikes, and I think they're both going to be a quarter of a point, which is really practically, it's still fairly nothing. 2 rate hikes is not going to drive this market down. It just won't. There's too much money coming into the market if Trump does get his budget approved to have 2 interest rate hikes. Just be like, oh goodness gracious, let's go down. You have to normalize interest rates in terms of getting into that. What I would call normal is the Fed fund rate being right around 4 to 4.5% and we're still under 1% here, Tim. So I've said this for the last year, and especially the last few months, is in terms of the market cycle, we're definitely at the top of the cycle, but we don't know if we're at the top of the mountain yet, right? We don't know that, and we're still going up. We can't even see the top of the mountain yet, right? But it's somewhere up there. It's a little cloudy. You're looking up on the horizon. You just can't see the very peak yet. But I don't see that this year, and that's my market prediction coming into this year was around a 8% increase in price, between 5 and 10% increase in price, and I don't see anything in the market or from the Fed that would cause me to come off that the prediction. Warren Buffett came out in an interview just yesterday, Tim, and he said that he doesn't see any reason why stocks don't appreciate in value, and I agree with that. Unless the Fed aggressively raises rates, with the money coming into the system, asset prices should increase in value. That's what inflation does. It increases asset prices.
Well, and you've got a lot of mixed, markets going on here as well. I mean, the one thing with the dollar in a head and shoulders pattern like it is, and if you're a technician out there, look up the head and shoulders pattern. I have concerns that probably as in almost any of the markets, probably with the dollar as much as anyone, Matt. And that pattern I don't love, but also the idea of spending our way into another couple of $1 trillion worth of debt I don't love as well. What do you think
It all
with the
comes to a
currency?
head, T.
Right.
It all comes to a head at some point. At some point, you got to pay the piper. You cannot continually rob from Peter to pay Paul. At some point, you have to pay down the debt. At some point, debt becomes just strangles us from an economic perspective, and you damn better be ready for more debt.
Yeah.
I think a conservative estimate would be at least $1 trillion a year. A conservative estimate, and it amazes me that the Conservative Party is so willing to use debt as a vehicle to drive asset prices,
Hmm.
and not to real America, right? Not to their consumer base, but to corporate America, Wall Street, and just the people who have asset prices out there. So for most people, what's going to happen is you're going to see an increase in cost because you're going to see an increase in inflation. It's going to be worrisome for the American consumer. For the top of the market, it's obviously very good, and you've seen that with asset prices over the last few months. So I'm very cautious about the debt burdens. The what I'm seeing around the world is the world is starting to shift away from the dollar to a certain extent from a reserve currency. But we've said here on the pod, we've said in the Coaches Show, the dollar is still the prettiest girl at the ball, and from a currency perspective. But when I'm looking at the dollar index right here, my current projection is down. Unless it breaks 102 on the dollar index, it should come back down or stabilize, which should mean positive for commodities, Tim, like gold, like silver, like oil as well. So those have an inverted relationship for the most part. Not all the time, but for the most part, if the dollar goes up, commodities go down. If the dollar goes down, commodities go up because commodities are priced around the world in U.S. dollars. So if I'm looking at a little bit of a bearish signal on the dollar, which I don't think you can make an argument that we're not seeing bearish signals on the dollar. Things can change in the future, but right now it is in a bearish technical pattern. Then if that's the case, and you don't know how to protect the dollar, and if you don't know how to trade the dollar, and if you don't know how to sell the dollar, then go look at gold, which is basically on terror year to date so far. It's went from 1125 to 1250. I don't see any signs of that slowing down in the near future. Silvers went from at the first of the year right around $15.80 an ounce to $18.36 an ounce, and that has not had a retracement either since the first of the year. So you're really bullish on silver, you're really bullish on gold, you're slightly bearish on the dollar right now because of the technical pattern, and oil is really kind of just stabilizing. But I will say, and I want the listeners to kind of track this week. If crude oil /CL, if crude oil does break out of, we'll say $55 a barrel, a close above $55 a barrel, it can get into $58 to $60 fairly quickly, and that's a good opportunity.
There's no question about it. There's a definitive work that started the conversation on intermarket analysis in the 1990s by John Murphy, Matt. I read the book, but quite frankly, what I've learned over the years is you actually learn this stuff by just watching these charts every day and every week. And I recommend a daily or a weekly routine for all of our listeners where you track, the S&P, crude oil, gold, as part of the top of the markets. That's what the market Skyline's all about. Guys, you've been listening to the Trading Justice podcast. We're going to come back and we're going to take a look at a strategy here, Matt, called the Iron Condor for episode 206. One of my favorites. And here's a short break and these words from our producer, Cam.
Oh, hey, you're new at trading? Nice. Me too. Today I feel like a Snapple, so here's a tip for you. Tackled Trading has put together a 7-step guide to help new traders understand the ins and the outs of the market. Stop living by the motto, que sera, sera, and take control of your financial future. And do it with Tackled Trading. And now for our featured presentation.
Strategies. One of the very first books I ever got was by a guy named Lawrence McMillan. You and I actually saw, I don't know if we went into the event. We met Lawrence McMillan.
You saw him. I met him later.
In New York City, remember that?
This was back in, it was 2009.
I think, yeah.
Or 9 or 10, one of the two. And we were in the middle of creating the trading system for legacy education, and we spent about 2 years researching, back testing, all these different strategies, concepts, techniques, rules, trading rules, and we wanted to spend some time with some of the greats out there, the John Bollingers, the Steve Nissens, the Lawrence McMillans of the world, these amazing authors, right? And we were at a trade show in New York City. When I can't remember what trade show we were at, but we were at a trade show and there's all these different companies, brokers, authors, seminars, you name it, right? And Lawrence McMillan was giving a speech there, and you met him, and then I met him later. His book, and what's the name of the book, Tim? I always call it the Bible.
I actually think he might have come out with a title called The Bible later, but it was called Options as a Strategic Investment, very formal. He's an old
investment.
floor trader from
Yeah,
Chicago. I mean, he's like what they call the godfather of the options market, how he brought it to retail
yeah,
investors. And I I watched him teach a class, Matt. It was incredible.
yeah.
And the reason I bring up that book and Lawrence in general is the first strategy that I ever did from that book was a spread strategy. And I remember how he listed them out. And that book probably has
Hmm.
200 or 300 strategies in it, 3 or 4 pages, 5 pages a piece, 10 pages, some of them, where he details how they work. And I eventually ended up with a strategy in there called an Iron Condor strategy. And I thought to myself, you know what? This one seems really awesome, really exciting, really interesting. And I learned that strategy from that book. But I didn't learn how to make money on the strategy from the book. And this is the
Yeah,
difference between how markets work. Today we're talking about the Iron Condor strategy, and I want to get into terms like probability and delta and system. But I want you to first kind of explain to everybody out there what is the difference between a just strategy by definition, because we can do that, and a strategy by system.
okay, which is application. Um, you know, I've said this before, and some people don't understand it. You can't, the only thing books will teach you how to do if you don't have something to supplement it is how to lose money. That's what will happen. So you go read this book, right? Options as a strategic investment, and you read this 10 pages on this Iron Condor, and it's like, oh wow, that's awesome. I can go
Mhm.
do that, and as long as it doesn't move, and we're just saying it's going to go neutral. That's it. Oh man, and we're going to get paid 10 to 15, 20% in a month. That's awesome, right? And then you go do it, and then it tests you. It tests the bands, right? And then you don't know how to manage it, or you over position size, and you make mistakes because of management and whatnot. So when you're talking about a strategy, like a cookie cutter strategy in a book, here's what the strategy is, here's the definition of it, here's the rules, here's this, right? But when you're talking about it from a systematic approach, it takes it to another step. When it comes to this system of a strategy, it's not just what the strategy is and what the rules are, it's how to manage it. It's what to do with the different legs if XYZ happens or ABC happens, which is one of the most important parts of trading is not the understanding of the awareness of the strategy, but actually how to trade it and how to manage it. And that's where system comes into place. The Iron Condor is a wonderful, wonderful strategy that can be placed on anything. You can place it on stocks, indexes, you can place it on commodities, you can do it on anything. And basically how I see the Iron Condor, Tim, and this is how I kind of explain it, is basically what the Iron Condor is it's an insurance company, is what it is. And is and what you're basically saying is that the market is not going to go here and it is not going to go here, right? So if I'm looking at, like, say, let's take Amazon for example, Tim. So if I'm looking at Amazon, Amazon is currently priced at
Mhm.
$845. So Tim, I'm going to ask you a question. Is it more likely that Amazon will go from 845 to 900, or is it more likely that it won't go to 800? Which one's easier to justify, that it will go to 900 or it won't go
Well,
to
building
800?
trades based on the idea that it won't get to somewhere is obviously a higher probability than it will get to somewhere.
Exactly.
And so,
Well, but that's what the Iron
mhm,
Condor is saying, though, is you're basically saying that it's not going to go to 800 and it's not going to go to 900 in the next 30 days.
sure.
Okay. And if it doesn't go to 800 and if it doesn't go to 900, you're going to get paid out money. And, if we'll just take those 30-day numbers. Let me give you some math behind it, Tim. So if it doesn't go to 800 and if it doesn't go, and I'm just going to give you a single contract here. Okay. So if it doesn't go to 800 and if it doesn't go to uh, 900, so let me change those to the strike prices of 900 so I can give you the actual numbers here, Tim. So 900, and then we'll just say we're going to do a 10-point
Hmm.
spread here, T, just to give you the accurate numbers. Okay, so if it doesn't go to 800 and if it doesn't go to 900, you have to put up $860. Okay, that's how much you have to put up. No, excuse me, $840. So you have to put up $840 in margin, and you're going to get paid $166 in cash. Okay, which is right around a 20% return on investment, right? So if it doesn't go to 800, if it doesn't go to 900, you are going to get paid 20% return on investment. That's what the Iron Condor is. Now, then you have to get into the complications of, or the difficulties of, okay, you're going to sell a delta of this strike price, and you're going to do it in a spread to cover your risk and all of that. But at the bare bones, that's all the Iron Condor is, Tim, is you're just saying it's not going to go to two levels on the chart, which is always a infinitely higher probability than saying it will go
100%
somewhere.
makes
Does that make
sense.
sense?
And I think if you're listening out there, and there's a couple things that need to be understood. Number one, this is an advanced strategy. Okay, so now that doesn't mean that it's complicated. I don't think trading at all in general is complicated once you learn it, Matt. But it is, compared to some simpler stuff.
No.
An advanced strategy, I would say, is fair. You're using 4 option contracts. Number two, before you ever trade a strategy live, you need to make sure that you know all the numbers, how to build it, get education on it, apply it. There's a process to it, and there's a lot of content. Tackle Trading's YouTube page has a bunch of stuff on Options 201, the playlist with Iron Condors. If you put in the word Condor in the search at Tackle Trading, Matt, you'd get a bunch of resources that would help you. But frankly, I learned more about the Condor from mentors than anything else. Micah Brooks and, the way Tyler Craig does it, or even Jim Francis. We've had Jim Francis on this podcast before, and Jim talks about his credit spreads with Condors and the way he does that system. It's a really powerful technique.
Well, again, it goes back to, learning a strategy from a book or learning it from a mentor, in terms of system. When you hear about this strategy from a book perspective, you basically become aware of this strategy, right? You become aware that, all right, if I sell the 800 strike price and I buy the 790 strike price, I have a 10-point spread. The margin requirement is going to be 10 minus credit received. If I sell the 900 strike price and I buy the 910 strike price, I have a spread, and you're going to $10 you have to put up because of the spread. So you learn kind of the terminology of it. You become aware of it, but then I could not imagine going out and trying to trade that, Tim, because when I read that book and when I learned the Iron Condor, I had supplemental material. I didn't just have a book or a website or a YouTube channel. I had Micah Brooks. I had Keith King. I had Gina Porter. I had, you and me were going through it. So we had mentors and we had coaches who had done that and been there and traded this strategy. And so it wasn't just about, okay, Matt, you're going to sell the 10 to 15 delta on the call side. You're going to match it on the put side. It wasn't just the rules and the awareness. It was the application of it. And that's where the most important thing in learning a strategy is. Yes, you have to learn the rules and you have to learn, what strike prices are and what deltas are and, the theta rule and whatnot. But at the end of the day, you have to do it, right? I mean, the rules are very simple, Tim, all right? This is a 30 to 60-day strategy. I typically prefer 30 unless it's on an index, where I typically prefer 60. But this is a 30 to 60-day strategy typically, where you're basically going to take advantage of theta, otherwise known as time decay, which will eat up the value of the options that you sold, so that you receive credit on a daily basis, okay, until the point of expiration, where typically the value of the options you sold are zero, which means you're going to keep all the money. The deltas you're going to sell is typically between 10 and 15 deltas. Why that is so important is that's going to create a range where the stock can go up and down, or the index can go up and down. You do not want the condor being touched. That's where mistakes happen. So if we sold the 800 and the 900 the 800 put spread and the 900 call spread, Tim, if we sold those, we don't want 900 to be touched. We don't want 800 to be touched, because that's where your risk lies in the condor, is if those bands get touched, and that's where the difficulty in management comes.
Well, I mean, if you automate, though, it's really not a difficulty in management, which is where, a lot of the tips I will give, new traders is to go to automation, Matt. I know that in the Cash Flow Condors video series that Tyler Craig is developing, that we'll release later in the year, um, he talks about automation where you can put your stop losses in advance. Because the rules are fairly straightforward, like you just described. There's a time rule. 30 days for stocks, 60 days for indexes is the range you like. There's a delta rule. There's a strike rule. There's ways to build it. I fairly believe I've seen this over the years. Anybody can learn how to do these strategies, Matt, just with, time, application, and motivation, right? And
Yeah.
this is a good one for most options businesses. Not.
Well, then, Tim, I got a question for you then. Okay, so let's say you have a Condor, this
Mhm,
this one on Amazon, and you sold the 900, you sold the
mhm.
the 800s, right? A- An advanced trader would say, well, instead of putting a stop loss at 800 or at 900, which is a contingent order on the spread, right? Instead of doing that, why don't you just roll it down and out? Or why don't you just roll it up and out? Why can't you manage the trade to make you more successful? What would you say to
I
those
think
people who
that
would
it's a
suggest
fair
that?
question, and there's not one right answer. And I always go back when I'm mentoring somebody: time commitment, degree of difficulty to execute, your role with the market. I mean, how do you want to run your business? I use a phrase, Matt, quite often: build the business you want, not the one you think you have to do, right? And if you prefer being able to walk away from it without emotion and let the trade kind of execute itself, automation is great. Some traders like the challenge of rolling this and adjusting that and turning the condor into a new spread and rolling it down and out and all that. Frankly, that increases your need to check the market, every day, all day, and maybe not even all day, but just every day regularly, and then also firm decision making. So I'm open to it, Matt, when I'm mentoring
Mhm.
somebody, but I don't always suggest it.
Well, and also, as an advanced trader, you might have a little more skill set than someone who is fairly new to the market as well. You might have that ability to rotate the strikes up and out or down and out. It's like an NBA player. Kyrie Irving might have a little more handle than you do, right? Which means he could do a little more
I've got a
plays
killer
and whatnot than you
crossover. I don't
can.
know if you've seen
Same
it.
concept here. I have seen your crossover, and it's not that good. But but the point remains here. If you're looking at a condor and you're in your first year of trading, right, or even if you're in your 10th year of trading but you're not new to condors, you probably don't want to aggressively manage that thing because you're most likely going to be rolling your risk and you don't understand that. I think for new traders, and I think for probably 90% of traders out there, just set up the management, keep it systematic, right? If 900's hit, just call a spade a spade. You were wrong. It went to 900. If 800 right, if 800 gets hit, call a spade to spade. It went to 800. Do not turn a small loss into a big loss is what I would suggest. And a lot of times when you get people talking about trade management, a lot of times I come back and I just say, okay, I get it. There's a time and a place for everything. But for the most part, when you do advanced trade management, a lot of times you're rolling risk is what you're doing, which means sometimes you're compounding risk, right? And don't overthink it. Keep it simple. Don't take small losses, turn them into big losses. That's how you blow up accounts. That's how you're not trading 10, 15, 20 years from now is if you try to get too creative, if you try to get too good. Just follow the rules, right? As time goes on, as you get better and better and better, then you can start doing a little bit more advanced stuff. But the reality is, for the most part, you don't have to. I would say follow the rules for the most part. Set a stop. Don't micromanage manage your systems. Do not turn small losses into big losses. Keep the emotion out of it. Stick to the rules. Now, Tim, what are the benefits of? Okay, so coming back to the Iron Condor, you can do it
Yeah.
on anything, right? Let's talk about price ranges though, okay? Because iron condors can be difficult on cheaper stocks. So when you're looking for an iron condor, what is the price range you're kind of looking at it
Well,
on a
I would
condor?
say this. I've had more success and more consistency with bigger stocks. and that's the recommendation I make.
Hmm.
It doesn't mean you can't do smaller stocks, but it does change the nature of the game. The nature, how big your window is, how big the spread is from short strike to long strike, things like that. So when I'm filtering that, usually the
Yeah.
minimum price I'm going to set is 50, but I usually start with a filter at $100 or more. Yeah.
Yeah, I'd say over 100. I would say over 100. Again, you can do it on less than $100 stocks, but there might be better ways to do it. Like Tim says, it does become difficult in terms of, the spread and the contracts and so on and so forth. But I would say above 100. Anything under 100, you might want to look at a short strangle, which is a very similar strategy to the Iron Condor, or you might just want to do like a naked put in terms of selling insurance on that. So there's different ways to cash flow in the same capacity. So we're looking at stocks over 100. Second question I have for you, Tim, on the Iron Condor is is liquidity important to you on a
Oh yeah,
Condor?
major. Million shares or more, it's got to have liquid options in the chain. By the way, I think one of the most common mistakenly, held concepts is the idea of open interest in volume on the specific strike that you're using. I've heard mentors or even coaches or
Hmm.
books say you got to have 100 open interest on that strike, and that's not a rule I use. I think that you've got a litmus test there where if you know how to look through the chains and the different expirations, you'll have a good idea on how to judge that. I know why we create minimums like that, but that's not necessarily always needed. If I,
Well, the broker told me one time on that, Tim, is you don't if it says
yeah,
zero, you
that's
can be
true.
the first, right, on volume. Um, so I agree we should have minimums. Um, just make sure that the spread is tight. And what I mean by
Hmm.
that is the bid-ask spread. If you have a very wide bid-ask spread, you're going to have liquidity problems. If the bid-ask spread is tight, you're typically perfectly fine. For you new traders, you probably want to stay with monthly options instead of weekly options because monthly options will definitely be a little more liquid than your weekly options as well because they've been traded for a much longer time period. So you're always going to have more open interest. You're always going to have more volume on monthlies than you will on the weeklies. I'm seeing that on Amazon as well. So we're looking at stocks above 100. We're looking at stocks that are liquid on the stock, but also liquid on the open interest on the option chain on the strikes that we're using. We're going to prefer monthlies, but we can use weeklies. Now, Tim, in terms of the rules for the strategy, I do as an analytical person, I'm a very rules oriented individual. The rules are for every option strategy, you have two rules. You have your delta rule and you have your theta rule. Okay. In every contract in the options market, you have two clauses. You have the set date, which is the expiration date, and you have the set price, which is the strike price. Those are those two clauses in every contract. And delta defines the set price, which is the strike price. Theta defines the set date, which is the expiration date. Now, as this is a selling option strategy, we are going to sell less time. The reason we're going to sell less time, ladies and gentlemen, is simply put, the way theta works, as it gets closer and closer and closer to expiration, you're going to start to see more and more and more time decay coming out every single day, and that's what theta is. It is time decay, so there's a curve to it. With about 1 to 2 months of time left in the option contract, you're typically decaying at 1, 2, or 3% on every day as you get closer and closer and closer into expiration until the point of expiration where it's basically, there's no more time decay. So we're going to sell shorter time frames, typically speaking, 30 to 60 days, depending on if you're a stock or an index. You can sell less time than that in weekly strategies as well, but let's stick to the basics. The delta rule determines the strike price in the contract. And the delta rule we're going to sell is, and this is my rule, is somewhere between 10 and 15. I want to match the call delta. I want to match the put delta. We're going to stay in that 10 to 15 range. Now, Tim, what that means, and I know you know this, but for the audience, that means you typically have 80 to 90% probability on success of cash flow. When you have 80 to 90% probability to gain 8, 10, 12, 15% return in a month, that's very, very important. So those are the rules. That's what we're looking for. Now, Tim, let's talk a little bit, and we already talked about kind of the overview, the mindset of we're basically saying the Iron Condor is not going to go somewhere. It's a neutral to slightly bullish or neutral to slightly bearish trade. Tips and tricks, Tim. What's a tip that you would give our listeners as they
Number
start to
one
trade
is
Iron
trade it
Condors?
outside of earnings cycles. Like for example, a lot of tech companies, they report late January. Well, after volatility has been crushed out of that, usually volatility will lighten up. So a condor in February or March would be a good plan, because you're dropping that. So there's one tip, Matt. I would say trade it when volatility is expected to drop. And that's right after the earnings, the next month or two after the earnings. Another tip I would.
And you're not talking implied volatility here because that drops too, but you're
Actual
talking just the
volatility,
price
actual
movement,
volatility.
correct?
And then the
Yes,
other one I
gotcha.
would say is if you're looking for kind of a laissez-faire, approach to it, trade a cash settled index, something like RUT or
Yeah,
SPX. They're called European. They're
SPX,
called European style options.
NDX.
That doesn't mean that they're in Europe. They're actually listed on the CPO.
And you can still manage them the exact same way that you do individual options on stocks as
Yeah,
well.
absolutely. And then number three, Matt, here's a trick. Tip, I don't know. Maybe it's a tip or a trick. I don't. You can tell me. But when in doubt, go lower delta. So, like for example, you had
Yes,
mentioned,
trick.
10 delta. And sometimes traders will be looking at the levels and they'll say, okay, I've got a 12 or a 7. Which one should I go with? And I usually give people the recommendation, the advice that when in doubt, go lower delta because that will increase your probability.
Yeah.
What are some of your tips and tricks?
When in doubt, no, when in doubt, always go more conservative. Always go more conservative. Always go less deltas, all of the jazz. So I like those. I like. I was gonna say the index one. I think cash flow condors is on the Russell 2000. It is not on a stock. I think the reason that's important is indexes don't move as fast as individual stocks do. You sell a 10 delta on Amazon, you got 90% probability. You sell a 10 delta on the Russell 2000, you have 90% probability. So based on the option pricing model of the Black-Scholes, you have the exact same probability, right, going into the trade. But on Amazon trades at about $10 a day right now, and that's very low for Amazon. Historically, Amazon could trade 12, 13, $14 a day. So it would take approximately 4.5 days of downward movement
Yeah,
to
yeah,
puncture $800, right, Tim? Okay. When you're looking at the Russell 2000 here, okay, the Russell 2000 trades about 13. I'm gonna go get that exact same 10 delta on the put side that we got on Amazon, just to kind of show you the average price movement here. So the 10 delta on this one is 1280, so it's got to move 108 points. So Amazon would have to move 45 points, and these are just your dollar figures, and the Russell would have to move 108 points on this one. So if you're looking at that, it can go down about 7.5 days, Tim, before that the strike price you sold. So you got the same probability on the option pricing model, Tim, but you actually have a significantly higher probability on the actual range of the stock that you're selling. So that's why I think it's important to have to have people look at cash settled
sure.
indexes like the Russell 2000 or the Nasdaq 100 or the S&P 500, because you actually get and this is kind of the trick I'm getting into, but it goes to the same thing. You want to sell at least what I call at least 4 ATRs away, okay? But anything above 4 ATRs away is really good. On the Amazon trade we were looking at, you had 4.5 ATR range. So what ATR is average true range. That's how much price it moves every single day from the high to the low. So on average, if this stock just went 4 days down in a row, Amazon would be hit, but the Russell 2000 wouldn't. Think about it like this, guys. It's harder to move 2,000 stocks as the Russell 2000 than it is an individual stock. And so when I'm looking at a nice little tip here, let's include the ATR. For those of you that are a little more advanced, let's start using the ATR as a barometer to really kind of, vary those deltas. Because if you just focus on delta and you don't actually focus on the range that you're selling from the stock price to the strike price, you're comparing apples to oranges. So if you take the ATR range, that is comparing apples to apples. So Tim, I'm going to ask you this, coming back to this. Would you rather sell a 10 delta on the Russell 2000 or a 10 delta on Amazon? They're the same probability, right? But if you take into account, would you rather sell the 10 delta on Amazon that has a 4.5 ATR range, or would you rather sell the 10 delta on the Russell 2000 with a 7.5
I'd rather have more
ATR
cushion.
range?
I'd rather avoid the corporate event
Yeah.
risk, even though I think Amazon's a great company. Well,
Takes out earnings.
that's right. Takes out the
Takes out
earnings
earnings too.
risk, takes out individual company event risk, takes out sector risk. I mean, Russell 2000 has 2,000 companies built into it. So I'd rather do the index. And I think that it's a good tip that, when doing this kind of stuff, when you do a broad-based index, you are removing some of those variables. And I love this thing you talk about called ATR cushion, Matt. I will give somebody else another tip, and that is go download a spreadsheet from Tackle Trading called the Tackle, I believe it's called the Tackle Theta Research, Matt. As a pro member,
Tackle
you get
Theta
access
Research
to the
spreadsheet.
Tackle Theta Research, and it actually does that calculation for you in the Iron Condor Research tab, which is something that helps people understand the nature of their risk and their
Well,
cushion.
yeah, and that's in there because it's so important to us. That data research spreadsheet was something we've designed over years and years and years, and it's really is our go-to to make sure that you're following all the rules of an Iron Condor. And we not only have the Tackle Theta Research, but we have the portfolio design spreadsheet, and we have the Tackle Trading Journal. All of them we value at $95 a pop, and we just give them free to any pro member, guys. So go check out Tackle, use the coupon code Justice15, and at the worst case scenario, you cancel, you don't pay any money, but you get 3 awesome trading journals that can help you in your trading. Our hope is that you'll love us and you'll stay with us, but at the same time, we'd like to give a ton of value to our clients. There's no doubt about that. Another tip I want to talk about is in that spreadsheet is called Royd, Tim.
Like
For the
Mark
longest
McGwire and Sammy
time
Sosa.
in
Explain what Royd is.
yes, Royd, and honestly, that's
Sure.
where I created the name. Royd is an indicator that I created years ago. And when we first started learning how to trade T, and we were starting to learn how to do credit spreads, and an Iron Condor is a credit spread, we learned bull puts, bear calls, Iron Condors. And every coach, every mentor, everything we read, it was always like, okay, you want to get at least 10% of the spread. And so what that meant, guys, is if you're selling a 10-point spread on Amazon, you want to get at least $1 on that. If you're selling a 5-point spread on Apple, you want to get at least 50 cents. And so on the credit received, you want to get at least 10% of the spread. And so I would be looking at this, and I'm thinking, okay, well, and this is 5, 6, 7 years into my career, right? And I'm literally just sitting down one day and I'm thinking 10% of spread, but that does not take into account delta, right? That the same thing with if all you do is focus on delta, it doesn't tell the whole story. It just doesn't. The same way we were just talking on ATR buffers, right? It doesn't tell the whole story. So I was thinking, okay, I could sell a 20 delta on this spread and I'm getting a 10% return, or I can sell a 20 delta on this spread and I'm getting a 5% return. I'm still getting the 10% of spread, but obviously the one is a little better than the other. So what I did is I started taking, and this is an indicator I created, I started taking the return on investment divided by the delta. And I created, and then I back tested everything, and I created these ranges to where you want to get in terms of really good Iron Condor. And I created these ranges based on just my own research and my own experience, my own trading and whatnot. And I created the Royd indicator, and it's literally, it's like credit spreads on steroids, and that's why I named it Royd. But in essence, it just takes ROI and delta. So what I'm looking for on this, and I'm not going to teach Royd in this. We'll probably do Royd. We'll do Royd in a coach's show. That'd be a little better in the coach's show. But what you're looking for in the Royd on a really awesome Condor is you're looking at least 140% on the Royd. And I'm not going to teach. That's for the tip and the trick for the advanced students, the pro members out there that are using the Tackle Theta spreadsheet. that's where you're looking at a really good credit. You got a great ATR buffer, you got a great ROI, and you got a great delta, and that's a spread you
Yeah,
can sell any day
absolutely.
of the week.
And probably the biggest tip I would give everybody out there is develop a cash flow strategy like Iron Condors. We talk about covered calls, naked puts, vertical credits, the OPM covered call, also known as the poor boys covered call. We use all these phrases and terms, Matt, but
Yeah.
at the end of the day, you got to have a way to make money from time passing. Robert Kiyosaki talks about other people's time, or other people's money, I should say, and we're talking about other people's time. Sell it, sell their fears, sell the risk, and
So,
generate cash flow.
well, the last thing I'll say on the Condor, and then we'll take a break and we'll come back with the Coach's Mailbag is this. When you're base Condors are basically, and I love how Tyler puts this in Cash Flow Condors. He said, in this system, we're basically selling the perception and we're buying the reality, right? We're short perception, we're long reality. The perception out there in the market, especially on the indexes, is there people panic, people crazy, people they doomsday, the end of the world is happening. But the reality is that doesn't happen very often, right? The reality is the market doesn't move that fast. The reality is stocks typically don't move 10% a month. The reality is market indexes hardly ever move 10% a month. And so in an Iron Condor, you're basically selling the perception that the markets are fast, and you're buying the reality that the markets are actually slow. And that's a lot of people when they first come to the market, Tim, they think the markets are fast. They're not. They sometimes seem fast because of leverage, but the markets actually trade less than 1% every month in terms of most markets, and same thing with most stocks. So when you're looking at that, when you're saying, okay, the markets are actually slow, the reality is they are slow. That is what we are buying. The markets are slow, and we're just going to sell that to somebody else who thinks the markets are fast. And so that is what we do. We sell perception, we buy reality.
Shut up and sit down.
Time for the TJ Coaches Mailbag. Submit your questions to team@tackletrading.com or reach out to us on the community. We're taking questions always. Fellas, take it away.
Welcome back to the Trading Justice Podcast. Got a nice little segment here for all of you lovely listeners, and we call it the Coaches Mailbag, where we take a few questions from our amazing students every single week, and we answer them on the podcast. The first question I have for you, Tim, is a fairly simple one. It comes to you from the clubhouse of Tackle Trading, and it's basically and let me get the individual who was asking the questions very quickly, Tim. So. Okay, right here. So, great listener, student, member, Christian. Christian says, Tim, I was looking at information on Google for WDC, but information was missing. There was no open, there was no high, there was no low, there was no market cap. Information was just not listed. And Tim, I've seen this on FinViz. I've seen this in TOS. I've seen this on Google. I've seen this on Yahoo Finance. I've seen this on almost every website. So when you're looking at a publicly traded company like WDC,
Well, the
why would there
advice
be
I would
missing
give in
information?
general is the same advice our father has given us a million times, Matt, learning how to build houses. Measure twice, cut once, right? Usually when you see a red flag, it's just probably missing data or a data
Yeah.
feed or there was a mistake or who knows. See, data gets pulled from lots of different locations in the market. I'll even give you a different one, Matt, that I saw just the other day in my class. I saw a PE ratio, and I can't remember the company, but I knew that this was a wrong number. It said something like negative 800 PE ratio, and I'm like, of course, that's wrong. So when you see a red flag, I would always go check a different source of data, which is where you need a brokerage account. I would have jumped right into my Thinkorswim or Tastyworks or whatever broker I was looking at the time and looked up the data there. Simply probably just bad data.
Always go to your broker. They're going to have the most accurate information. Always go to your broker. But I've even seen, in the fundamental tab on Thinkorswim, I've seen data that was not accurate, and was missing. Sometimes it's how websites. Sometimes you just have data problems when you talk about websites. Sometimes how they calculate that data and when they populate it might be different. You will see sometimes on Yahoo Finance versus, Thinkorswim versus Google. They might have different PE ratios depending on how they calculate it, end of day or real time. There's just check another source. Measure twice, cut once. Wise words from our father, no doubt about that. But it's just due to missing data, and it does happen. If you see there's no P ratio on Apple, we know that's not accurate. There's just missing data. Go to your broker software. Second question I have for you, Tim, and this is an important one, and this comes from one of our students, and he just goes by the credit guy, and he says, why the divergence between GC and GDX? Any opinions on which will likely lead the other?
Let's first describe what GC and GDX are. The GC is not just GC, it's actually /GC, which means it's a futures contract. The gold contract traded on the CME, which is the Chicago Mercantile Exchange, Matt, as you know, is the direct price of gold as an actual commodity, right? And so when you're watching the commodity price, that's very different than what GDX is. And GDX is an index that tracks the price of the gold miners. Completely different deal. So let's first start with the simplest answer here, and then we'll get into the divergence and why they may be diverging. The reality is we're tracking different things. We're tracking gold mining companies against gold, right?
Yeah. Well, and you're not just tracking gold mining companies, though, Tim. You're tracking all miners. Okay. There's actually other miners in that as well. I know we call it the gold miners, but there are other miners in there as well. So it's mostly gold, but some of those companies also, they don't just drill for gold. They also drill for silver and other metals as well. So it is going to behave differently. They typically will track one another, but from a percentage perspective, they will behave differently. It's very similar to the market indexes, Tim. The S&P 500 and the Dow and the NASDAQ and the Russell, they typically track one another, but some might go up more, some might go down more. And they're not going to do the exact same thing all the time. So you're tracking two completely different things. You're looking at one, the actual commodity versus two, the ETF. You also have to take into account the fact that not only are they tracking different things, one miners and two a commodity, there also, there are fees within an ETF as well. Now those fees are typically less than 1%, and we don't really care about that. But there are there's management cost in that as well. So there are different things in terms of that. Now I got another question for you here, Tim.
I want to give a tip on that last thing real quick.
Let's see, which one do I want to go?
When
with?
you're dealing with an index that tracks companies,
Okay,
I want everybody to write down the word holdings. Okay, and so one of the fastest ways you can go understand what's going on with your index might be one individual company. And go write down the top 10 holdings of those ETF indexes, and then you can dig into it a little bit deeper. Anyway, good question out there, by the way.
Okay, Tim. Here's a question. Okay, this comes from Antone, one of our members over there at Tackle Trading. He says, when a stock gets adjusted on the weekend, can the movement be addressed as a change of sentiment
I
on the
actually
direction
saw this
that was
question,
just
and I
adjusted?
answered Antoine's, in Tackle Trading's Clubhouse. Love these questions, by the way, Matt. The Clubhouse is ramping up over and over again, getting more active all the time. And what I would tell Antoine again, like I did in that thread, is it's probably just a gap. And yes, that's a reflection of sentiment, but mostly just supply and demand. Sometimes a stock will gap over the weekend a little bit. It can actually gap a lot, depends on the move. A gap in price is just where it closed on Friday. Matt, let's give them a number like $50. And then on Monday morning, you open up your account, you open up the market, you look at it, and it's like at $52, right? That would be an up gap. So yeah, bullish buyers or buyers of the stock are showing an increased demand for the price and willingness to pay it. So you could say it was sentiment, but I want to use the word gap here to describe it, Matt. And study gaps. Gaps can happen for a lot of different reasons. Could be that the industry moved. It could have been the overall market move. It doesn't necessarily have to be direct sentiment on that company, but you will need to understand what a gap in price is.
Love it. And I agree with that. And the last question we have for the coaches mailbag this week, Tim, if a bull put is both in the money, okay, so you've sold a bull put credit spread, and let's take the Amazon trade, for example, okay? So if we sold the 800 strike price put and we bought the 795 strike price, that's a credit spread. So if that goes to say 790 or 780 or 750 in the next month, what will happen to each leg?
So let me make sure I understand this
on
one
the
exactly, because this one comes, and who's the student that asked this one? One of our team members?
This one
All
comes
right, Chris.
from Chris,
So if a bull put is
member
both
of the
in the
clubhouse.
money and didn't close the trade, so
So
both
once
legs
again,
are in the money. Is that right?
if
Yeah, the broker
yeah,
will end up settling this
both
trade out
legs are in the
for
money.
you because options that expire in the money, they don't officially expire worthless. What happens is they expire and they have to be forced assigned. Part of the nature of the contract. That's right. Now here's
There's going to be
the
intrinsic
good
value there.
news, Chris. If there's a problem with the assignment in your account, you will be getting a phone call on Friday in mid-morning from somebody nice on the phone from your broker, and they'll tell you, hey, listen, you got to close this out before the end of the day. We don't want to do the risk of the assignment. So long story short, Matt, it will kind of handle itself out, and you will take a max loss if both are in the money. See, remember, when you sell a bull put spread, you want it to expire out of the money, so this trade has not gone where you want it to go. I will tell Chris this. It's much better for you to manually buy it back on a loss because you have to look up and understand something called an assignment and exercise fee. Depending on the nature of the broker, they might call it one thing or the other, but that's what it is. And usually that fee, Matt, is more expensive than your commission cost to buy back the spread. So it's better for you to control it and get out of it and take the hit than just to ignore it and let it expire.
Well, and if you don't do that, Jim, you're going to either get a phone call or you're going to get a very weird email from your broker saying you have to pony up $10,000, right? When it's not true, but they're basically, because if you sold the $800 put option on Amazon, you are willing to buy it at $800 is what you're willing to buy it at. And if you bought this $795 put option, you're willing to sell it at $795. So basically what will happen is you will buy it at $800, sell it at $795, but the broker handles it for you. It's much better, much cheaper, typically just to close the spread if you can. Even if you have to break the legs and close one side of the equation, that is typically the better thing to do. But no, even if you get an email that says you owe $10,000, that's not how it works. You still have both contracts. You have the contract on the short side of it, which you're willing to buy the stock at that price. You're willing to sell it on this long put contract that you actually sold.
Missed one of our previous podcasts? No biggie. You can find the Trading Justice podcast on tradingjustice.com, tackletrading.com, TuneIn, Stitcher, and iTunes. Leave us a review. Helps other traders find this invaluable information. Let's get back to the show.
Welcome back to the Trading Justice podcast presented by Tackle Trading. Hopefully you enjoyed the sultry, sexy voice of producer Cam. Yes, Cam, I said it. Sexy. We're at the last segment of the show, and this is one that people have a tendency to really enjoy, and that is the Clown of the Week. And we all have our nominees, okay? We all have one Clown of the Week as our nominees, and we're going to start with producer Cam.
A Texas lawmaker hopes to pass legislation to discourage people from using the Chilean flag emoji to represent the Texas flag. Republican State Representative Tom Overson authored House Concurrent Resolution 75 urging Texas not to use the flag emoji of the Republic of Chile when referring to Texas. So this is Texas pride to the max, taking shots at emojis.
I've had a million. I will start with something. I've had many students from Texas come out. One thing that we do downtown in mentorship, Matt, I like to do is walk around. You've made fun of me a million times on this, but I also like to drive around. I'll get in the truck and we'll go up behind the Capitol downtown, And we were looking at the building. He says, you know what? That Capitol looks just like the Texas Capitol. And then just like a Texan, he said, did you know that the Texas Capitol is 3 feet higher than the U.S. Capitol in Washington, D.C.?
Of course he did. Of course he did. Yeah, that had to happen. Texas is my adopted home state, right? Utah's home. Texas is my adopted home state. I love Texas. Everything Texas represents. So, but this is ridiculous.
Right.
First of all, it's an emoji, typically on Twitter. Who cares, right? But to have a resolution put to the Texas state floor in law is beyond insane.
I had a couple of potential choices here. I will leave the ones I didn't choose for another time potentially, and I'm going to offer up my clown of the week as the GOAT, the greatest of all time, Tom Brady. And I'll explain why. There's the big controversy over him and his missing jersey, right?
Yeah.
Well, apparently Tom Brady has created a crime board, a suspect board is what he calls it, and he started putting pictures up. He put this on his Instagram the other day, and I think it's kind of fun. I think it's kind of ridiculous, which is the nature and spirit of Clown of the Week as you go. Now, here are the suspects, Matt, that Tom Brady himself has identified. By the way, he has put $500K as the value of his jersey. Maybe. He's got the scene of the crime up there. Gollum from Lord of the Rings is one of the top suspects. I can't trust him. Julian Edelman, he put up there. Some guy named Bad Kid Gary, which is a cartoon. Don't know him. O'Doyle's dad from Happy Gilmore or Billy Madison back in the day. Jaws, right? Steve Carell, Lady Gaga, Scooby from Scooby-Doo. Really? The clown who stole Air Bud in the Air Bud movie. Brady's obviously having some fun with this one, so I'm going to have some fun with it as well.
All right. Third one. Mine comes from NBA All-Star Weekend. When Kyrie Irving was being interviewed, he was asked if he believed if the world was flat or
I already know the answer to this.
This is absolutely ridiculous.
Do you think he really thinks it,
that he thinks the world is actually flat? I mean, this led me to look at this YouTube video for 30 minutes about this guy who truly does believe the world is flat, and he's laying out his evidence. All the time I'm thinking, are there people this insane? And then Kyrie Irving is out there saying the world is flat, and it's like this guy travels in a plane. There are pictures from space with the planet, right? With the planet.
Like, I just don't believe it. I think they're trolling us. I think they're trolling all of humanity, and they probably laugh their butt about it when it gets retweeted a million times. You said it yourself. Kyrie Irving went to Duke. He's been in a plane. He travels all over the country. I'm calling. I don't know.
Dude, he sounded serious. If he's trolling, I don't know. But here's some quotes out of all the podcasts. That's what you took out of it: the flat Earth, the fact that it's a social phenomenon that Kyrie thinks the world is flat. He called himself third person, is hilarious. Does it matter to you that I believe the world is flat? Okay. Irving then states it really doesn't matter. The fact that it's a conversation, I'm glad it got people talking. That doesn't sound like a troll, Tim.
But I'm gonna stick with this Texas lawmaker. I think he's a little sensitive, and it looks bad on Texas.
Kyrie Irving is my vote for Clown of the Week here.
I love Kyrie Irving. I think, and I love LeBron James, and I love greatness, and he is a great basketball player. His handle is beyond ridiculous. I think Kyrie Irving has a better handle than Steph Curry does. I do. And Steph Curry's handle is ridiculous, right? I think Curry's got the best handle in the game, bar none. He is a cold-blooded, just killer down at the end of the game. The guy is just flat out. He just has ice in his veins. The guy's awesome. The shot he hit in Game 7 little step back 3-pointer, little fade action. It's one of those, no, oh my God, he just did that type thing. And so I say this because I really do respect Kyrie Irving, and I like Duke as well. But come on, the flat Earth, seriously, that is the dumbest thing I've heard, perhaps in my life. And I have heard some dumb things, but that is one of them. He's clown of the week. And Kyrie, we love you, but we're gonna have to tweet. We're gonna have to tweet you with some. We're gonna have to tweet you and hashtag clown you. We will not, because of his greatness.
Oh no, go
We
after
will not.
him. Come
put
on. I mean, he's
any type of clown shoes on the picture. Just hashtag. I got so much respect for his handle, dude. I got so much respect for his handle. But yeah, Kyrie, stick to basketball. We can talk science if you want, but let's leave it with the whole world is flat type stuff. Although, listeners of the podcast, I am open-minded, and if there's anybody out there that agrees with Kyrie Irving that the world is flat, please send me your information, post it in the clubhouse. I am an open-minded individual. I do look out my window, and it does look flat. So if that's the case, show me your evidence. But I'm going to go ahead and believe that. But I do have a question for you guys. The level of skepticism that we have to have as a society that leads people to believe that we constantly just get lied to about the world being flat around. It's utterly ridiculous. We're going to leave it at that. Hope you guys enjoyed the podcast, listening to 206. Thank you so much for being the best part of Trading Justice and Tackle Trading.
Trading Justice Podcast brought to you by Tackle Trading. Music brought to you by Bensound and bensound.com. Catch us next week for another incredible episode of the TJ Podcast. Until then, we'll see you in the clubhouse.